Yeah, thank you so much for your great inputs throughout the week. We really enjoyed.
Good, thank you. Your voice is slightly breaking, but I think we are just about to hear you.
Okay. So we are a small group here. We are six, seven of us today.
Good, right? I can count is easy. You can't lie in numbers. That makes life easy.
Yeah. Yeah. So over to my colleagues.
I can't hear the actual speaker. The mic is thank you.
So we could grasp the fundamentals very clearly. In fact, the course structure, flow, everything was very good. However, I put one suggestion in my feedback form stating that the feed could be broken into hourly basis instead of pushing them and 3 times a day. That's my thought. As a social interaction, we could have expected more interactivity if it was broken into hourly and the feed was distributed hourly. Maybe others would put their note.
Yes, any form of weekly interactions, good, and this community learning is kind of where it comes from. Whether you start off as an open-ended Q&A and say, right, ask me any question you want, and we kind of take it from there. It's something that can be explored. I don't see that as a problem. I think the challenge for us at the time we started release was we didn't know the starting point where everybody else is coming from. So to get everybody on the same base in that sense of the work, and then I think in kind of version 2, let's say when this is done in 2017 when Brexit happened in Trump and won, will be quite entertaining to do. And yeah, that we do, that we ask, people ask questions and the resource person will compile those. But I have to hear any thoughts.
Please, take it. It was nice hearing you. My name is Sarat, and I also come into investment advisory is my second profession, vocation, occupation, and the quotes on Warren Buffett and the Rule 72. I think that's what you mentioned also. That was actually quite invigorating and pretty practical and easy to understand and grasp. But we keep seeing, and in terms of financial acumen and that basic financial education is important for all. And I'm also part of a Wealth Creators Club where we meet once every month, and we are on a learning mode where we are actually doing book reviews of like Benjamin Graham and things like Peter Lynch or John Bogle. But yeah, the whole I think idea behind is that to keep doing your systematic investment planning, the SIPs, and we invested in the markets and not move around much. So that's something that is really people move around too much and then they burn their fingers. Yeah, and so that right, I would actually like to hear from you on Brexit also. That what do you think it has for the financial markets, and how do you think it could be?
Absolutely. I agree that I think so. In terms of mention about turnover and people trying to move across asset to assets of, let's say, investing in Airtel about 20% of your portfolio and then moving it to Reliance because some money has launched Geo and is going to destroy everybody is a fine tactic, but So I was involved in some research that was done by my investment house that I work for AXA within fixed income investment, equity investments. And the what research shows within institutional investors, these are people that pay half the fees that you and I would pay at any point in time. They lose anywhere between 0.5% to 1% of portfolio in just turnover. So to your point, anybody who's effectively trying to kind of find the next apple, so to speak, which is what they can do, becomes a very big challenge. So the general idea of that comes from, in order to mitigate that, what you do is effectively diversify forward. So you have either investing in various funds of mutual funds across various companies, kind of stuff. But clearly, if your portfolio is slightly different, so if you have a big Gurgaon that's giving you rent, you can take some form of risk directly. Then you can invest certain pots directly in that company. So then I will talk about that. It's kind of how your financial asset allocation can be looked at. On Brexit, that is a gift that keeps big, shall we say. I was in the US about a month or so ago, and just when you thought Brexit had kind of finished all the challenges it could do around property prices, around exchange rates, and exchange rates are a funny one. That's the first space where you see any immediate impact of economic announcements across everywhere. And so I was in the US. I was traveling, I was in an Uber, going from my house to the airport, and Theresa May announced that they will exit officially by March, and the pound dollar exchange rate went from 1.3 to 1.2. And I had to convert it. I had to convert it at that point effectively. So I lost about 15% of value sitting there in the Uber, stuck in the traffic jam. So it's if that keeps giving. I suspect there will be another impact around March, April, when some details are known. And the most amazing thing for me about the Brexit so far is nobody knows anything. So it's all based on speculation, some form, because people are imagining the models of probably Singapore, the models of Norway, whether Germany will stick to its line, because there's a big political risk for Germany coming, that if they allow Britain to operate the way they want to, which is effectively get access to the open market, so effectively being able to sell British goods in Europe without paying any tax. And at the same time curbing immigration, which is kind of the principle of the European Union of one market for capital and labor. If they break that fundamental rule, then there are various other European nations that would want to separate, and can lead to a spiral effect such that all you have left is Germany, France, and Greece as the European Union, so to speak, and the rest are just agreements with it. But like I said, we don't generally what we are expecting is the model now effectively says, compared to what it could have been, there will be 0.5% to 2% GDP loss over the next 5-6 years in the UK. In Europe, we are still not sure of. The other thing that is expected is there will be in the next 2 to 3 years potentially some tax break for companies, medium and large, here in the UK to keep them here. That is expected to be announced at the end of this year sometime, but it's obviously a function of Europe. And yeah, it'll be based on speculation. Expect some challenges. Well, November 8th will happen, which is a US thing. But then for Brexit, I would expect around March to have some form of change in exchange rates, good or bad. We just have to see.
Hi, my name is Ashok Kamal. I have a very different kind of a question to ask to you. When you see right from the time that we got independence, which is now 70 years, we were on a socialistic kind of economy in which the taxation rates were very high. And it's only, I would really say, in the last 2-3 years, I do not agree with the Manmohan Singh model of liberalization that took place in the 90s, that we started moving away from a black money economy. See, one reason why India did not get so much affected in the 2008 crisis, because we had a parallel economy of black money going on, which this government is trying to rectify, into trying to bring everything into one module. So right now the real estate sector and the manufacturing sector in India is really affected because there was a lot of black money economy that was going in. Probably that's going to change with the GST coming in and with this IDS that is just closed in September 2016. But the sectors really you don't know, because this black money economy was ultimately created because of the socialistic economy. So people will be almost taxed 100% of their taxes if you took all taxes into effect. So ultimately the person has to survive. Now when you shift from one model to another, it does take time. And the playing rules change. So what is your take on this? Because we have to get used to a new norms of playing, which the businessman does take its time and the economy also does take its time. Like we don't see anything happening in the real estate sector where a large amount of black money transactions did take place, whether into investing or whether into selling or reconverting. So that is a huge slowdown, and which is a very big sector in India.
I would agree to some extent saying that yes, black money was a nice option when it happened in 2008. It will take time, you're right. And I think it comes down, at least one of the things is the population believing that taxes are being used to some extent. So arguing for the two aspects. So one is arguing for rule of law, saying that if I don't pay my taxes, I will be scrutinized, etc., which is quite a big thing here in the UK. So on an annual basis, everybody has to do a self-assessment or effectively do your own income tax online, or you just have one job and you get simple TDS and they can do it automatically. The other point that you're saying is that as we move away from less of black money, more money in the financial system, generally speaking, will that create a chance for us to be rich gypsy style? Probably, right. Will it increase chances of that happening? At the same time, it also allows, if it is done right, it allows the system to be slightly more resilient. And what I mean by that is, where there is inefficiency. So, for example, old age homes can be one example, where right now there will not be enough investment made. It's a very big investment sector in the UK and in the US, and that, for example, if the market is, I wouldn't say fully efficient, but relatively efficient, can allow that sector to get the capital that it needs, which let's say may not happen in the black market economy because people just don't see it as a big push. For example, will people get hit if, or will the individual laborer get hit when the black money moves out of the system? Probably because they have to pay some degree of taxes. There's no universal income in India in that sense of the word. That kind of socialist impact, moving to capitalist impact, where you have to effectively fend for yourself post-retirement, will create a challenge both at the individual level and at the society level. And it will probably take a generation that believes that taxes are getting utilized in some form efficiently, and that they're a bit scared that if they don't pay the taxes, bad things will happen. So financial penalties primarily is what I expect to happen. It won't be an easy transition. There will be a lot of people who will probably not do it, like anything that 10% will always try to game the system. Will it make it better overall? I guess I would say yes, because it then a very open system where I guess again it's coming from outside in, you are able to say to the world that look, we become more transparent, our taxes are clearer, our ability to raise financing is clearer, and makes on average it makes it better and more open. And you're right, the challenge of being more open is that you can move around with the world. And there will be bits around it where you invest in industries which are not that linked to the entire financial aspect. So, old age home was one example, investment in IT infrastructure and incubators that companies can be another example, where those are the things that are coming up and it has the resources which can help it do that. So there will be challenges. It's almost like the immigration debate that's happening a lot in Western world, and that's so it's people who are trying to make a better life for themselves. So if you change that to capital, it's capital trying to seek more return in the best way they can. And India has an opportunity there. So that was a very long-winded answer, and I don't know if I actually answered the question. But I'm hoping
I think all that I can get from your answers is that one has to be optimistic and look towards the future with optimism.
Probably, sorry, I was thinking out loud probably, because I never thought about that question. But yeah, I think optimism helps quite a lot.
Hi, my name is Kushak Srivastava. And I wanted to ask you that I was studying a lot about the 2008 financial crisis, and the one thing that I took out of it was a lot of people, like a lot of good people in the society, like for instance, professors from Harvard, Stanford, on the board of the directors of Goldman Sachs, Morgan Stanley, all those who were making those tranches which weren't good, right? So, and companies like AIG, insurance companies, S&P, and all those rating agencies, everything was crooked. But when we study finance, we take two types of risk, right? A systematic risk and an idiosyncratic risk. But what about when these people like these, they have their own incentives and they were running on their incentives? How, as a person, if I'm investing in a mutual fund or investing in stock market, should believe these people? Because I know everyone is somewhere down the line looking for his incentive, and these people from we can take a note from 2008 financial crisis, that everyone somewhere down the line is looking to make money on his own, and no one actually really knows where the market is heading or what they can do. So how should I be sure enough, or what should I do if I want to invest in mutual funds or say stock market? Thank you.
If only I could answer that question. It is, so I think you would have to, back to the optimistic question. So you'll have to be, to some degree, optimistic. When it comes to mutual funds, the only thing that you can do is figure out how the underlying investment manager is doing the research. So taking an example, let's say if you decided that you don't want to invest in mutual funds and wanted to invest in and geo stock, things that you could look at when you're investing in stock is simply how much of the current price is reflected in what you expect. So let's say the price is 100 rupees per share. You'll have to build a financial model that tells you how much of future expected income is built into that price. You will also talk about free cash. So how much cash flow the company is generating, how much it has as a result of its kind of continuing operations, expected future operations. So that's the other thing which often is not thought about often enough by both the individual level and by some of the investment managers that are picking stocks is the point you made about alignment. So whether the management board is aligned to the board, the executive board. So these are the CEOs, the management company, the management guys that are running the company. How much of their interests are aligned? And from an investor perspective, what you then do is you make sure that your investment managers, the guy who's taking stocks on your behalf, or you do it yourself, effectively tries to use or ensure that there is alignment by reading out the remuneration committee notes that are published, by reading, asking questions to the board. So if you're an investor, you have the right to go ask them, how is my CEO getting remunerated? How are their businesses getting remunerated? In the UK, in the last 6 months, a year, a lot of REMCOs, that's remuneration committees, have proposed various policies which have gotten rejected by investors. For the same reason that you mentioned, post GFC, there's a huge focus at, and people have just said, no, you're taking away too much. So it's not easy. It is easier probably to get those, ask those questions and get those answered. For publicly listed companies, they have various rules that they have to implement, and it requires a lot of time. So you have to go, if you're investing in 5 companies, you need to understand the remuneration structures of 5 of them. Figure out whether, so this, I'm just talking at the board level, so where board and CEOs are aligned with the investor, the shareholder. Then the other point you mentioned is the brokers and the S&Ps of the world. Yes, so you have to make sure that the broker that you're buying the stock from, so SharePant.com or anybody else, average online will probably be simpler because they'll get a flat fee for every kind of information they check, and that's fair and simple. But if they are, you know, I have used SharePant.com and I'm picking them because that's one broker I know in India, where they have this. So imagine if SharePant pop saying this stock is really good, buy now. Are they getting incentivized to that? I would say don't buy it until you do. So I would, again, that's part of the alignment. So it's ask questions and figuring out who's getting remunerated how. S&P setup works setup. S&P is finished for setup companies rating so that you have to do less of that. But they are primarily a financial rating companies. What those things are meant to be, which, as you said, sometimes is not true. They're meant to be certain, saying company has enough money to pay its bills, has enough money to pay this bond, and is also registered company. What it doesn't do is look at the about the governance of the company. So again, remuneration structures and board alignments and structures. It doesn't do so. You need to get other sources of data, and there are companies that provide this kind of information. I can't remember them off the top of my head. But there was a company that provides that level of data. So you'll have to add, so if you bring it at an individual level, you'll have to bring all of that together, then take a call on whether the risk is worth the reward. If you're giving your money to an investment manager, then you need to understand how he's making those investment decisions, and you must incorporate the alignment of interest aspects as part of the decision making. And the only way you can test that is give it money and let it run for a couple of years and see what happens. And yeah, they'll have some good performance of how they've done in the last 5 to 10 years or 3 years. Some of them will be good, some of them will be bad. Classic question you ask them is things that you got right, that you got wrong. Give me an example of when you do a board. Systematic investing was mentioned earlier. There's a lot of stuff that happens there where computers are now able to effectively code. So individual researchers put in a rating for each individual stock at risk level, so both within finance but within governance as well. And then that allows the system to kind of rank effectively. and then pick stocks as well. So you can do both levels, and options are slowly opening up.
Thank you.
Hi, my name is Gaurav. So, I wanted to know if you can suggest some which you think are
Light has gone.
The back end
Hi, can you hear me?
Yeah, I can.
But we cannot.
Uh,
In the meantime, I will ask my question. When we get the electricity back, we will hear me.
yes, Gaurav.
Yeah. So my question is, like I'm not so much aware of finance things, but I want to invest. So can you suggest some sources of knowledge online which you think give correct information, are not biased, and which is not too technical, and maybe which can be translated into action, like which can help me taking some action. Okay, this is something little amount of money or this amount of money I can invest.
I don't know any as in right now off the top of my head. I think there are a few online tools which can allow you to give you they give you an idea of I'm trying to say, of what's the simplest way of putting it, of how a portfolio would look. So if you invested in A, B, and C stocks, I know there are a couple of people working on it. So in terms of content, so there is kind of the FTs or the Economic Times, which is decent. There is a company, there's a website called, I was reading this yesterday. There's a website called Money Google, which again is a UK based one. I think they do global markets primarily, just short, snappy ideas. CNBC on average is quite good, at least for some of the data that they have. And I'll find some more, and if you're on the WhatsApp group, then just message me your number and I'll find some and send you later on. In terms of trading portals, I generally don't know. I think ICICI Direct is useful, is on average decent cost. So this is trading, not telling you what to trade, but the cost of trading is. Then share here is decent, with the good online facilities, so you can read about individual stocks, what notes people are talking about, and kind of what the broker is suggesting the expected price to be, so to speak. But those are the tools that I'm aware of. I haven't done a lot of research, to be very honest, in the Indian broker. I don't know if anybody in the room has more names that they may be able to share. But if not, I will. Oh, we have. Sorry, I missed your name at the start.
Saras.
Saras, hi.
Yeah. So, couple of cases where you can get data is like money control, value research, online, but technically, theoretically, and practically, you just need to be a 10th grade pass to invest. What I suggest my clients is that you just invest in the market, right? You don't have to buy individual stocks that much if you don't know. The logic being the market, for example, in India, the stock market started in the 1980s and it started at 800, now it's about 28,000. So your birthright is a return of 16 to 17%. That, had you invested in 80, would have got you now, and that too without doing anything, at all. So you would have got that kind of return. And generation upon generation, we are going to progress. I mean, we are better off than our fathers, or fathers better off their fathers. So people actually get enticed by the ups of the stock market, and that's where they invest. And of course, it's going to come down, and then they end up losing money. But if you just keep steadily investing over a longer period of time, you will never be let down, and that's one source of income, like a passive income. Of course, you have your active income through whatever vocation and occupation you're pursuing, but just invest in the stock market in terms of buying the whole market, like the Nifty we have in India, which is a basket of 50 securities, and another is called a junior Nifty, or the Nifty Next, which is another basket of mid caps. So trust me, those companies, those 50 or 100 companies are not doing well. The Indian economy is not doing well, and if they go down, of course, the Indian economy is going down. So that's the stock market is the barometer of the financial condition of the country. So that's how I look at it, and that's how I've been taught and brought up. And of course, as part of my investor education initiative, I tell my customers and any prospective clients that just be invested in the market, and 16-17% is your birthright, being born in India. Thanks.
I might start with that. If I could get 16%, that would be awesome.
One thought that was there in the course was the use of algorithms, which still is mystifying, and the trust levels. Would you like to compare? Is there any study that has been done on the people who invested based on the algorithms versus the advice that has been given by experts who've been there? And has there any work been done to establish any kind of credibility on algorithms?
I'm sure the algorithm itself will be doing a study about how good the algorithm is. I haven't come across any so far which says that the algorithm will be better or has been better than the human advice. I can imagine, with the advent of machine learning, if you tell it that these are the right decisions to take, if this is the pattern that you see, then it can make up the rule of what it needs to be when it is that data thing. But that's a very theoretical concept. I haven't seen that implemented as such. I've seen that at a trading level. So there are a few hedge funds that do high frequency trading, and that's one of the things that they try to do, where they try to figure out how orders are being placed in the market and whether they're being reflected quickly in the price, and at the window of on average a few minutes, if not seconds, and that's how they try to game this. There are a few that are out there, and they will no doubt have data which will be for their client prospect. I'm not one of them, so I haven't seen that. At the individual financial advice level, I think I haven't seen any research. I don't know if it will fully replace the personal advice. I think it will aid the personal advisor to figure out what the asset allocation a particular person should be. So for example, when you, at least in the UK, when you go, the light's gone, but I think you guys can still hear me. Oh, it's come back. So in the UK, when you go to get a loan for a house, the advisor is sitting behind a computer. He asks you a bunch of questions about your income, your expenditures, the standard stuff that you make, that you need to make a budget, and he's putting in their internal model. And the only reason I can't do that is because that model is internal to the bank. I expect some similar will happening to a financial advisor's internal model. So rather than him doing the calculation on paper with you, they may have a model that they generate, which is in X% in equities, X% in bonds, etc. It incorporates your other financial assets, so your houses, your retirement income that's coming, and then it will generate an answer. Then it's up to the individual financial advisor to work with you to figure out whether that answer works for you. So the model may say invest in 30% equity. But if your next cash flow plan is you have to have expenditures a year and a half, then that's probably not the right thing to do, and you might want to invest less. So I see that more than the machine telling you exactly what to do. People listening to the machine exactly what they want to do. But yes, the people that are implementing those models, once they build them, then they might have to do something else.
I run a New Delhi chapter for an organization called as Founder Institute. It's a early stage accelerator basically. A lot of founders whom we meet are really confused whether to raise funds from friends and relatives initially, or depending upon the third party financer as a early stage financing, then grow the venture into the next level. So what is your suggestion on that aspect?
Well, it's not very good to your family member to take the money from them. You win ways. Sorry, that's too easy. I think it's better to some degree to have a third party investor, because nothing else, they force you to be prudent. They force you to be more efficient from a company structure to make sure that you are running your company more efficiently, because they will be kind of, they might be slightly different, but they'll be very focused on making sure that your business runs. They might also give you very clear feedback about why your idea may or may not work. And yes, there is a trust aspect which you lose, which is if they really like the idea and have a lot of money, they may hire somebody else to do. I think on balance, so it depends on how small you are, but probably, I mean, initially we all need friends and family to start up effectively. But I think stage 2 is probably slightly better to get third party. And yes, they might charge you slightly more, so they may take more out of your equity, or they may charge you greater interest if it's done on a loan. But I think the balance that it brings is an independent opinion and indirectly forcing you to be more financially prudent and economically efficient when you're running your company. Other people might have other views, whom I'm happy to, if anybody else has.
Yeah. Basically, most of them who come with their proposals are not really matured from the packaging or with their business plans, etc. Whereas they at their level, it is their perception that they have done their job, and they just wait for a third party financer to finance them and accept their idea for further growth, whereas it is not really happening. So in that process, they lose out somewhere between 6 months to 1 year. Just waiting for some early stage investor to come and pick their idea, finance it. So do you suggest really they should wait for 3 to 6 months kind of window before they start burning money from their own pockets or from relatives and friends?
I think it is waiting for some time to figure out. Sorry, was the question how long they should wait before they go to third party investors?
Yeah, basically the applications, say there are 30 applications we have received who have expressed that they would like to, or they are looking for money to raise their venture. Whereas when we scrutinized the papers and the preparations, 85-90% of them are not up to the mark. So we tell them, but it is a gray area, it's a debate again, So we suggest them, but really in preparing and making it a sellable idea concrete, there is an effort which is required. So no one else other than the founder, he himself has to put effort bringing or converting that into sellable idea. So that is where the catch is. That is where the time is spent between 3 to 6 months or sometime more than that.
I think on average I would say that 3 to 6 months the company should be running, so that you can see how they do business. Because if they've taken money from their relatives, etc., you want to see them deploying that capital as kind of respecting the capital as capital and not as अरे मेरे बाप का पैसा है. So that in order for you to see that, you need time to see how the executive is running it, so the CEO, etc. So I would allow them at least 3 to 6 months before kind of talking to them, unless you both feel that that idea is so good that it is worth going in early and telling them this is what you need to do, we'll give you some money, but take a lot more out of it effectively. So rather, if you're giving them 10% at 6 months, you take 30% and say we're coming in early and we'll sit on the board and those are the things that you bring to the table. If you feel that idea is really good and has enough future potential.
Mathematics over the period of time has needed market, like Ed Thorpe did in Professor Ed Thorpe did it in I think 60s or 70s. Then James Simmons from Renaissance Technologies did it. So there are companies like Quantopian which are crowdsourced hedge funds, right? So I was wondering how could like we start if a person who is interested in machine learning and algorithmic trading, how can we take things off on Quantopian and such like that? Because algorithmic trading in India is not I haven't seen a lot of it, and the thing with crowdsourced hedge funds like Quantopian is something that I was really excited to know about, and if you have any idea about it.
I wouldn't know much of the Indian crowdsourcing. I don't know the regs involved, but in the UK, crowdsourcing has become very big. So there are equity crowdsourcing hedge funds that you mentioned. There's also property crowdsourcing. So what that particular thing is tells that this is property they want to buy, this is the price, put in as much money as you want, and then the company also then puts that property out on rent. And you get the percentage that you contributed as income, and then if you sell it off, then you get the percentage back, or you get your percentage upscale. That's all. That's the crowdsource on that platform. I don't use it, but it is a very interesting idea. To do it in India, I think would be great. So you probably pick your asset class, pick one to start off with. Whether it is equities, whether it is fixed income, whether it is property, whether it is anything else that you can think of. I don't know. I don't know the regulations involved. Other people in the room might be able to help in that. How easy it is to set up crowdsourcing. But it's an idea that's getting a lot of traction everywhere. There's also a website, I think which is global now, called Indigo, which basically inventors effectively put up their machines or whatever they want to build. They produce a bit of prototypes. They say, if you give us 30 pounds or 50 pounds, we'll give you the first 5 that come out. If you give us 100, we'll give you this plus message. So there are tiered structures where you get people to invest in a particular product. That could be an idea. I haven't seen one in India yet. So if you can imagine a website, whatever, SRO.com or starttheglow.com or whatever you want to call it, where inventors of engineering grads come and say, we'll build this, tell them build a prototype, put it on the site, and then you have to spend a huge amount of marketing budget in getting it to the people. You might have to link it with lending accounts or something else, probably where they can invest in a particular fund, maybe at an administrative level, issue shares, but those are details that somebody can work around. You'll have to spend some time on the idea and the amount of marketing you need to do from it. Yeah, crowdsourcing is very important. I haven't seen that in India as such, but it's definitely an area worth exploring.
So thank you, Herschel, for having got up so early and responding. Is there anything you want to say by way of closing comments before you go back to sleep? Or? So there are no more questions at this end.
No, the questions are very good. Thank you so much. I at least got one homework to do, which is figure out, apart from share fund and ICI directed any more interesting ways. I've been keen to look at actually neutral media sites, figure out what are some resources to use. My closing comment would probably be thank you for involving me in this project, which has been a lot of fun. I've been doing some form of financial literacy work in the UK with kids in the school here. I am strictly moving to try to get an app around this idea, which will be working on the content at this point. The idea being building financial literacy, giving short snippets to anyone who is interested. Let's say when the idea will have a charity in the UK that's willing to work with us with these issues. And I think the broader theme is probably but beware in this day, keep eyes and ears open. But be optimistic and not investing early is probably my message.
That's exactly what Warren Buffett said when he was asked, do you regret anything? He said, I should have started investing earlier. So I think, well, wish you that you are on the path to Warren Buffett one day. All the best, thank you. You can go back to sleep.
Thank you guys.
So from this conversation,